Hey, tomorrow at 11 a.m. California time, we will be getting a Federal Reserve statement on whether or not they are going to reduce rates. And then at 11:30, we will get the Federal Reserve press conference. In this video, I'm going to give you a presentation of what to expect. So first things first, Barclays is expecting a no rate cut. It's also worth remembering that, and I mean the market broadly is expecting no rate cut either. This is pretty much the expectation at this point. It's worth knowing as well, though, that tomorrow's meeting will not have a summary of economic projections, so we're not really going to get any kind of adjustment on that SEP. However, I'd like to note that Jerome Powell often likes to distance himself from the SEP after the SEP release meeting. Sometimes he even does during the meeting the SEP comes out. And so what could happen is you could end up seeing a sort of talk down of the last summary of economic projections that we got in March. Now, the last projections materials are right here. And what we saw last time was that the snapshot in time, we thought for 2025, we would end up getting GDP to sit around 1.7%. I'm very confident Jerome Powell is going to get asked about the likelihood of whether or not there'd be any difference in GDP projections or the unemployment rate, especially since we just had the Q1 GDP numbers come in very, very low, 0.3%. We also had the Atlanta Fed real GDP indicator suggesting even exports, gold exports excluded, that we had a substantially low data set for Q1 that would be suggestive of a slowly moving economy. Presently, the Atlanta Fed real GDP number is higher, though. So who knows? Maybe it'll average out. Right now, the Atlanta Fed is showing about 2.2% on a GDP basis for Q2. So maybe Jerome Powell might give us a hint that, hey, the economy is going to continue to move in line with our expectations of the last SEP. If he says that, it's actually going to be a bullish move. So I would watch for that potential bullishness because these SEP numbers are not that bad. 4.4% unemployment, and then 4.3 for the next 2 years, 4.2 in the long run. This is no problem at all. Now, when you start seeing a 0.5% rise in the unemployment rate from where we are, you get back to sort of the fears about triggering the Somme rule. You did have one individual here project 4.7. But I don't think we're actually in a place where Jay Powell is going to suggest, hey, any of this seems to be weakening. If anything, I would expect that he might mention that inflation could be higher in 2025 than previously expected. But you'll notice they already built that into their summary of economic projections last time during the March meeting. And that, mind you, was before Liberation Day. Now, since then, we have heard Jerome Powell say that tariffs have come out to be a lot larger than expected. So we would anticipate that maybe if the board was going to revise their SEP or when they come out with their new SEP next month in June, that this number here will be higher. But so far, it doesn't seem like the Fed is seeing any real signs of damage in the hard data. And I don't think we're going to get a Powell tomorrow that really indicates any concern. Now, don't get me wrong. We're starting to see high frequency data, like in the video we talked about this morning, starting to roll over, and I encourage you to watch that. But let's keep going with what we've got from Barclays here. So Barclays suggests they expect the May FOMC statement to acknowledge that near-term inflation expectations have moved up, but that longer term has remained relatively anchored. And that's a good thing. This is usually calculated or sort of read off market expectations through inflation break-even estimates. And if you jump into what BNY suggests, BNY has their piece right here. Market pricing agrees with no cut for tomorrow, maybe a 27% chance for June and a 64% chance for July, but those longer-term inflation expectations are still very well behaved. And if this remains to be the case by the end of July, that's when we could potentially see a cut. Why? Because of a rollover in the jobs market. So in other words, we could pay attention to inflation expectations as short-term, get a bump in the road, longer term stable. As long as we remain stable, maybe by July, unemployment data ends up rolling over. And that's the big red flag, but we're just not seeing any of that data yet. In fact, obviously, the April numbers beat really well. We were expecting 13,000 jobs. We got 117,000. Mind you, this survey was taken the week after Liberation Day, so it might not fully encompass the damage yet of tariffs and sort of the length that tariffs have been going on. We're now celebrating what, May 6th. We're celebrating essentially, a full month here post Liberation Day of tariffs, and so far we don't have a single deal yet. There is talk, mind you, about a deal with the United Kingdom, but what's really interesting about this talk with the United Kingdom is this idea that we're only going to see some limited, maybe lifting of auto part tariffs or auto tariffs along with some quotas, but there's no talk in the UK trade deal about removing anything with regard to reciprocal tariffs. So, in other words, even if we get this sort of deal on auto quotas and auto parts or steel and aluminum, we're still having issues on pharmaceuticals, reciprocal tariffs, and the larger tariff sets on, basically all other goods other than cars and steel, which is interesting because now this is being called potentially and hopefully the next and first big trade deal that Trump's going to get to announce, but it's really just going to, if this is what it ends up being, address part of the issues that we're facing, which isn't really great. We've got this view here from BNY that by the time June data is published, the jobs outlook will start to deteriorate clearly. And I think this actually sets up a potential issue when you get into mid-June, because you're going to have a lot of folks that will start clamoring for the Federal Reserve to cut rates. And it's possible that they will, but my guess is they're going to want a full quarter of inflation data before being willing to respond to these cuts. They're also going to want to see, will Doge actually create any inflation? I know that second one is going to sound a little weird. We'll talk about that in just a moment. But think about this. For you to actually get 3 full months of inflation data, you're looking at the May inflation report, the June inflation report, and the July inflation report. All right, cool. So when do we get the July inflation report? Well, we can go to the CPI schedule of releases. And the July inflation report is expected to come out right here, August 12th. All right, great. So that means the earliest you would have 3 months of data for the Fed is probably going to be September. So you could Google, we'll go to FOMC schedule, jump back in here, FOMC schedule. You can see we're not going to have a Fed meeting in August at all. So by the time you get 3 full months of inflation data for the Federal Reserve, you're actually going to have to wait until September to realistically price in one of your first reactions. And see, the Federal Reserve is of the mindset that they can cut rates very rapidly. So who knows, maybe you even get a 50 basis point cut here. But the problem is, this quarter right here, May, June, July, is where we'll probably start seeing unemployment rise, shorter-term inflation expectations continue to rise, and a Fed that does nothing. And when the Fed does nothing, people get very nervous. They're like, oh no, this is bad. Now, obviously, right now we expect the Federal Reserve is going to be in no rush, and that's fine. But once we get closer to actually seeing some of those early job cuts, people are going to be really nervous, like, why is the Fed not cutting yet? So you're going to wait for a quarter of data. We've seen that in their behavior at the beginning of 2024 when they were talking about Q1. Oh, 1 month doesn't make a trend. 1 quarter was a little elevated. We're willing to wait a little longer. That's going to be a risk factor. So the Fed being slow here is probably the biggest risk. And I think I'm going to be looking for clues in terms of how many inflation reports Jerome Powell really wants to look for to see that tariff impact. I don't think he'll give us an answer because it's likely just way too soon to tell. But when you think about it, logically, if you were the Fed chairperson, yeah, you're probably not going to desire to react until September, which means, again, that June-July period, August even, with no Fed meeting at all, could be a little nasty. Now, on top of that, there are articles circulating right now that Doge isn't actually saving money, that Doge might actually end up costing us money, that, it was supposed to be a $2 trillion goal. Then it was a $1 trillion, and, then it'll go down to savings of so far only $150 billion. And a lot of that was sort of cutting DEI expenses and basically cutting programs, not necessarily finding waste, fraud, and abuse, although some will say DEI programs are wasteful, but not necessarily fraudulent. That's fine. But what's interesting, obviously this is just somebody's opinion that Doge could end up costing more money. I think what they're really doing is they're just saying government spending has just continued to skyrocket and deficits are rising. And if we walk into a recession, deficits will rise even more. So we'll have more debt rather than less. I mean, I always think it's good, at least somebody's trying to bring efficiency to the government, which I'm a big fan of. But one thing that is interesting that I hadn't considered before was this right here. The downside to Doge's Valley of Tears, a demoralized workforce and bad headlines about non-existent savings that can be presented as a win. So in other words, this potential demoralization of government workers in terms of, hey, your job isn't safe, why work hard, you're expendable. Nobody really knows what that potentially is going to entail longer term. But if we do see a decline in government productivity, it is also possible that GDP declines because of that, keeping in mind that government spending is part of our gross domestic product because it enables money to circulate through an American economy. Just like when we trade with China, I thought it was really interesting. T.S. Lombard had a great piece this morning, maybe I could pull it up, where they show that when we buy things from China, 50% of the money that goes to basically Chinese companies in exchange for those imports ends up in America again. Take a look at this. So of the money that's spent on Chinese goods, it's actually 55.9% stays in America, which is the highest of all of the other countries that we would trade with, Japan, Canada, Mexico, Euro area, or whatever, which is fascinating because it really suggests that, hey, that a lot of that money can stay here. They give an example. When you buy a $100 pair of Nike sneakers made in Asia, only 25 of its costs goes to the Asian factory that manufactures the shoes. The remaining 75 is spent in the following ways. $350 to ship it from Asia to the United States, $21.50 goes to Nike to cover its design, marketing, profits, and expenses, most of those being U.S. expenses, and the U.S.-based costs like Nike employees and stuff, and the remaining $50 goes to the U.S. retailer that pays for the transportation of the sneakers inside the United States, pays the workers to sell it at the retail locations, insurance, rental space, blah, 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 whatever. So it's kind of interesting, like when you think about, oh my gosh, I'm buying this $100 shoe made in China, really only 25 bucks of it is going to China. Obviously, T.S. Lombard here says outside of the shoe example, in aggregate, it's closer to 44%. But on the shoe example, very little actually ends up in China relative to how much goes to support wages and American service providers here. I think all of this is quite fascinating data and creates very, very cool perspective. So anyway, my take on the Fed tomorrow and some other updates. Thanks so much for watching, and we'll see y'all tomorrow. We'll be live for it. Make sure to come join. I look forward to seeing you there. Thanks so much for watching. As always, remember, non-accredited round for HouseHack is open. Go to househack.com to learn more. Thanks so much for watching. We'll see you soon in the next one.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Bye.